Cash isn't just declining, it's being systematically dismantled, and what's rising in its place isn't what most people think. Look at what's happening right now. Physical currency usage has dropped below 15% of all transactions in major economies. Sweden's already at 2%. India eliminated 86% of its cash overnight in 2016. China's digital yuan is processing billions in transactions. The European Central Bank is openly discussing cash limits. But here's what they're not telling you. While governments push digital currencies, central banks are buying gold at the fastest pace in over 50 years. They purchased 220 tons in just one quarter recently, a 28% increase from the previous quarter. These aren't random purchases. These are strategic moves by institutions that see something coming. Think about what that means. The same institutions telling citizens to embrace digital currencies are simultaneously stockpiling the oldest form of money known to humanity. Why? Because they understand something fundamental about the transition we're entering. Digital currencies give governments unprecedented control. They can track every transaction. They can freeze accounts instantly. They can implement negative interest rates with the push of a button. They can program money to expire if you don't spend it fast enough. Gold does the opposite. It exists outside the system. It can't be printed. It can't be programmed. It can't be frozen or confiscated remotely. It's the ultimate opt-out from financial surveillance and monetary manipulation. Let me show you what's really happening beneath the surface. The war on cash started quietly. First came the convenience narrative. Digital payments are faster, easier, more secure, and they are for everyday transactions. But convenience was never the real goal. Control was. Banks started closing branches. A TMS became scarcer. Cash deposit limits appeared. Large withdrawals triggered suspicious activity reports. The infrastructure for physical currency is being deliberately dismantled. Meanwhile, central bank digital currencies, CBDCs, are being rolled out globally. Over 130 countries representing 98% of global GDP are exploring or piloting CBDCs. This isn't a trend. It's a coordinated transformation of the entire monetary system. And here's where it gets interesting. Every major CBDC pilot has the same features: programmability, expiration dates, transaction limits, and complete traceability. The Bank for International Settlements, the central bank of central banks, openly discusses using CBDCs for social credit systems and climate-related spending restrictions. Imagine money that can only be spent on approved purchases. Money that expires if you save it too long. Money that can be turned off if you say the wrong thing online. That's not conspiracy theory. That's literally in the technical specifications of CBDC systems being tested right now. But while this digital prison is being constructed, something else is happening. Gold prices hit all-time highs above $3,700 per ounce. Not because of inflation alone, not because of geopolitical tensions alone, because smart money, the money that moves before headlines are written, is positioning for what comes after cash dies. Look at who's buying. Central banks in China, Russia, India, Turkey, Poland, they're accumulating thousands of tons. The People's Bank of China added to reserves for 18 consecutive months. Russia's gold holdings now exceed its dollar reserves. These aren't investment decisions. These are survival strategies. They're building a parallel system, one where gold, not the dollar, not digital currencies, serves as the ultimate settlement layer for international trade. The BRICS nations are openly discussing a gold-backed trade currency. Saudi Arabia is accepting yuan for oil and converting it to gold. The petrodollar system that's existed since 1971 is being systematically dismantled. And here's what most people miss. When Nixon closed the gold window in 1971, he didn't end gold's role in the monetary system. He just postponed it. For 50 years, the dollar's reserve status was maintained through military power, energy markets, and network effects. But those advantages are eroding. The dollar's share of global reserves has dropped from 71% to under 59%. Trade settlements in yuan, rupees, and gold are accelerating. The SWIFT system, the dollar's enforcement mechanism, is being bypassed through alternative payment networks. We're watching the end of a 50-year experiment in pure fiat currency, and the reversion to gold-backed systems is happening faster than anyone expected. Now, if you're sitting on significant retirement savings, $100,000 or more in traditional accounts, this transition has direct implications for you. I put together a comprehensive guide on how gold IRAs work, covering how to get physical gold into retirement accounts without triggering tax penalties. It's in the description below. Worth reviewing if wealth preservation through this transition matters to your situation. Because here's what happens next. As cash disappears and CBDCs roll out, there will be a bifurcation. The majority will use programmable digital currencies for daily transactions. They'll have no choice. Salaries will be paid in central bank digital currencies, taxes collected in central bank digital currencies, and eventually, old currency will simply stop being accepted. But wealth, real, generational wealth, will increasingly be stored in assets outside the digital system. Gold, silver, real estate, productive land, businesses, things that can't be programmed, frozen, or inflated away with a keystroke. The wealthy already know this. Family offices are allocating 10 to 15% to physical precious metals. Billionaires are buying gold mines. Sovereign wealth funds are accumulating bullion. They're not doing this because they think gold will go up 20%. They're doing it because they think the system might go down 100%. Consider what happened in Cyprus in 2013. Banks froze accounts overnight. Depositors lost up to 47.5% of their savings above 100,000 euros. It wasn't a bailout. It was a bail-in, where depositors' money was used to rescue failing banks. That wasn't an isolated incident. It was a test case. The template now exists in banking regulations worldwide. Your deposits aren't really yours. They're unsecured loans to the bank. In a crisis, they can be converted to bank equity or simply confiscated. Gold in your physical possession can't be bailed in. It can't be frozen. It can't be digitally confiscated. That's why it's called a safe haven asset. Not because it always goes up, but because it exists outside the system that can fail, and that system is showing serious cracks. Global debt has reached $315 trillion, over 330% of global GDP. Interest payments alone are consuming larger portions of government budgets. The only way out is inflation, printing more money to service debts with devalued currency. But here's the problem with that strategy in a CBDC world. When money is digital and programmable, inflation becomes obvious and immediate. You can't hide currency debasement when every transaction is tracked and every price change is visible in real time. The illusion that sustained fiat systems for decades, that money holds value, becomes impossible to maintain. That's when the crisis hits. When people realize their digital currency is losing purchasing power daily, they'll want to exit. But exit to what? Cash is gone. Foreign currencies are all digital and inflating too. Real estate requires massive capital and liquidity. Stocks are denominated in the same devaluing currency. Gold becomes the only liquid, portable, universally recognized store of value outside the system. And here's what the price action is telling us. Gold isn't moving like a commodity anymore. It's moving like a monetary asset. It's rising against all currencies simultaneously. It's hitting new highs despite rising interest rates, something that historically shouldn't happen. It's outperforming stocks, bonds, and real estate on a risk-adjusted basis. The market is repricing gold from inflation hedge to system alternative. That's a fundamental shift. And it's happening while most investors are still thinking about gold the old way, as a portfolio diversifier or crisis insurance. The smart money sees it differently. They see gold as the base layer of a new monetary system, one where digital currencies handle transactions, but gold settles the big trades, where governments can control their citizens' spending, but international commerce requires something neutral and trusted. This is why central banks are buying. They're not hedging inflation. They're building the foundation for what comes after the dollar's dominance ends. Look at the mechanics of what's happening in the gold market itself. The COMEX, the major futures exchange for gold, has a paper-to-physical ratio exceeding 100 to 1. That means for every ounce of physical gold, there are over 100 ounces of paper claims. This works fine when everyone's trading paper. But when people start demanding physical delivery, the system breaks. We saw glimpses of this during COVID. Gold futures traded at massive premiums to physical gold, sometimes $100 per ounce or more. Refineries couldn't produce bars fast enough. Mints ran out of coins. The paper market and physical market disconnected. That was a stress test. The real crisis comes when the disconnect becomes permanent. When paper gold is recognized as just another fiat instrument, a claim on gold that may or may not be honored, while physical gold trades at massive premiums as the only real thing. We're already seeing early signs. Premiums on physical gold coins and bars remain elevated. Delivery times are extended. Central banks are repatriating gold from foreign vaults. They want physical possession, not paper promises. The London Bullion Market Association, the center of global gold trading, has been quietly tightening delivery requirements. They know what's coming. When the paper market fails, they want to be holding real metal, not IOUs. And this brings us to silver. Silver is gold's volatile younger brother. It's both a monetary metal and an industrial commodity, and it's setting up for an even more explosive move than gold. The silver market is tiny, about $1.4 trillion in total above-ground supply compared to $12 trillion for gold. But industrial demand is soaring. Solar panels, electric vehicles, 5G infrastructure, medical applications, they all require silver. And unlike gold, silver gets consumed. It's not economically recoverable from most applications. Meanwhile, silver production is declining. Major mines are depleting. New discoveries are rare. The silver-to-gold production ratio has dropped from 9-to-1 to under 8-to-1, but the price ratio remains near 80-to-1, meaning silver is historically cheap relative to gold. When gold moves, silver typically moves 3 to 5 times as much. If gold goes from $3,700 to $5,000, a 35% move, silver could go from $32 to $60 or higher. That's not speculation. That's historical pattern recognition. But here's the real opportunity in silver. The same forces driving gold, monetary system transition, CBDC rollout, dollar decline, apply to silver. But silver has an additional catalyst, industrial demand that's independent of monetary factors. Even if the monetary system somehow stabilizes, silver demand for technology continues growing. That's a double catalyst, monetary demand plus industrial demand. And it's happening in a market that's a fraction of gold's size. The potential for price appreciation is enormous. Yet most investors ignore silver. They see it as poor man's gold or a speculative play. They don't understand that silver has been money for longer than gold in many civilizations. They don't realize that silver coins were the primary medium of exchange in America until 1965. Silver is being remonetized. Not officially, governments won't announce it. But functionally, as people lose faith in digital currencies and seek tangible alternatives, silver becomes the accessible option. You can't buy groceries with a gold coin. But silver? Silver works. This is already happening in countries experiencing currency crises. Venezuela, Argentina, Zimbabwe, people are using silver coins for transactions, not because their governments endorse it, but because their currencies are worthless. As CBDCs roll out in developed nations, expect similar dynamics. Not hyperinflation necessarily, but financial repression, negative real interest rates, capital controls, spending restrictions, and in response, parallel economies using physical precious metals. The transition from cash to CBDCs isn't just about technology. It's about control versus freedom, surveillance versus privacy, system dependence versus system independence, and gold and silver represent the independent side of that equation. Now let's talk about timing. The cash to CBDC transition is happening faster than most people realize. The Federal Reserve is actively developing a digital dollar. The European Central Bank is piloting a digital euro. The Bank of England is exploring a digital pound. These aren't research projects anymore. They're implementation plans. Most estimates suggest major CBDCs will be operational within 2 to 3 years. Some countries are already there. China's digital yuan is being used by hundreds of millions of people. India's digital rupee is expanding rapidly. The infrastructure is being built right now, and as that infrastructure goes live, the pressure on cash intensifies. Why maintain expensive physical currency systems when digital alternatives exist? Why allow anonymous transactions when every digital payment can be tracked? The economic arguments for eliminating cash are compelling. From a government perspective, reduced crime, better tax collection, more efficient monetary policy, elimination of bank runs. From a control perspective, it's perfect. But from a freedom perspective, it's terrifying. And that's why gold and silver are moving now. The smart money isn't waiting for CBDCs to be fully implemented. They're positioning before the transition completes. Because once cash is gone and CBDCs are the only option, exiting the system becomes much harder. Try buying gold with a CBDC that tracks every transaction and flags suspicious purchases. Try moving wealth across borders when capital controls are enforced through programmable money. Try preserving privacy when every financial decision is recorded permanently. The window for preparation is closing. Not in decades, not in years, in months. And the price action reflects this urgency. Gold isn't rising gradually. It's surging in waves, $200, $300, $400 moves in short periods. That's not normal commodity behavior. That's panic buying by institutions that see the timeline accelerating. Central banks aren't buying gold for 2030. They're buying for 2025 and 2026. They know something, and their actions speak louder than their words. Look at what happened in 1971 when Nixon closed the gold window. Gold was $35 per ounce. Within 9 years, it hit $850, a 24 times increase. That wasn't just inflation. That was a monetary system reset, a repricing of gold from commodity to monetary asset. We're entering a similar reset. But this time, it's not just the dollar decoupling from gold. It's the entire global monetary system transitioning from physical to digital, from decentralized to centralized, from private to surveilled. And gold is being repriced accordingly. Not from $35 to $850, from $3,700 to, what? $10,000? $15,000? The math depends on how much of the monetary system's value flows into gold as the ultimate settlement layer. If gold backs even 20% of global trade, not as circulating currency, but as reserve settlement, the price implications are staggering. We're talking multiples of current prices, not percentages, and silver follows. With its smaller market and dual demand drivers, silver could see even more dramatic appreciation. A return to the historical 15-to-1 silver-to-gold ratio would put silver above $240 per ounce from current levels around $32. That's not a prediction. That's just math based on historical norms. But here's what matters more than price predictions. Gold and silver represent optionality. In a world of CBDCs and financial surveillance, they're the exit. They're the way to store value outside the system. They're the insurance policy against monetary experiments gone wrong. You don't buy gold hoping to get rich. You buy gold hoping you never need it. But if you do need it, if the system fails, if currencies collapse, if controls become unbearable, you'll be grateful you have it. And increasingly, that's not a doomsday scenario. It's a realistic assessment of where monetary policy is headed. Negative interest rates are already reality in some countries. Bail-ins are established policy. Capital controls exist in dozens of nations. Financial surveillance is expanding everywhere. The infrastructure for total monetary control is being built right now. Gold and silver are the hedge against that future. Not because they'll make you wealthy, but because they'll keep you free. And freedom, in a world of programmable money and financial surveillance, becomes the ultimate luxury. The transition from cash to CBDCs is inevitable. The technology exists. The political will exists. The economic arguments exist. It's happening whether we like it or not. But the transition from fiat currencies to gold-backed systems is also inevitable, because history shows that pure fiat systems always fail, always, without exception. The only question is timing. And right now, both transitions are happening simultaneously. Cash is dying, CBDCs are rising, and gold is being remonetized as the foundation of whatever comes next. The smart money is positioning for all three realities. They're adapting to digital payments for convenience. They're preparing for CBDCs as the new normal. And they're accumulating gold and silver as the ultimate backstop. Because they understand something fundamental. In a world where money is programmable, the only money that can't be programmed becomes infinitely valuable. That's gold. That's silver. That's the transition we're living through right now. The question isn't whether this is happening. The question is whether you're positioned for it, whether you understand the implications, whether you're taking action while there's still time. Because once cash is gone and CBDCs are the only option, the ability to opt out disappears. The ability to store value outside the system becomes restricted. The ability to preserve wealth independently becomes illegal. We're not there yet, but we're closer than most people think. And the window for preparation is measured in months, not years. Gold and silver aren't just investments, they're lifeboats. And the ship is taking on water faster than the crew is admitting. The transition is here. Cash is dying. CBDCs are rising. And gold is reclaiming its role as the ultimate money. The money that exists outside systems, beyond control, immune to programming. Long live gold. Because in a world of digital surveillance and monetary manipulation, it might be the only thing that keeps us free.